London, Reuters, a marked shift toward protectionism by President Donald Trump caused sharp outflows from U.S. large-cap stocks this week, Bank of America Merrill-Lynch, BAML, strategists said on Friday. Investors rushed into government bonds and other safer assets amid rising fears of an international trade war after Trump-Euro trademark's plans for tariffs on imported steel and aluminum met barbed responses from allies and trade bodies. Overall, investors pulled money out of equities, though the damage was mostly in the United States where $10.3 billion flowed out of U.S. equity funds, while global equity funds suffered just $0.4 billion of outflows, according to EPFR data cited by BAML. A euro as QE ends, protectionism begins. A euro wrote BAML strategists. The risk-off mood drove investors into money market funds, pushing assets up to $2.9 trillion, the highest level since 2010. Safe haven gold also drew in $0.4 billion. U.S. small caps were sheltered from the storm, the only U.S. sector to draw inflows, albeit tiny at $0.03 billion. U.S. large-cap stocks lost $10.1 billion. Flows into Japanese equities continued apace, with the market drawing in $4.1 billion in its 14th straight week of inflows, the longest streak of inflows since 2013. European stock funds managed to draw in $0.1 billion. Trump-Euro trademark's exemption of Canada and Mexico from the final tariffs announced late on Thursday soothed investors somewhat, and news the U.S. president would meet with North Korean President Kim Jong-un caused crude prices to rise. A Euro's DPRK Daton suggests protectionism can remain at a euro bark a euro not a euro abide a euro stage a euro argued strategists. Among large economies, China has the highest dependency on exports to the United States and therefore looks the most vulnerable to U.S. protectionism. The Hong Kong dollar is the a euro ultimate China U.S. trade war ply a euro, said BAML. Hong Kong is firmly in the crosshairs of any potential trade war as its currency is pegged to the US dollar but its economy is highly reliant on China. The Hong Kong dollar has sunk since Trump's tariff talk began and hit a fresh 33-year low HKD equals D3 on Friday. Bull bear down to 6.8 as credit markets falter. The approaching prospect of an end to quantitative easing also caused outflows from rate-sensitive credit markets, driving BAML euro trademark SA euro bull and bear euro indicator of market sentiment down to 6.8, down from 7.6 in the previous week. The indicator euro trademark's 10-point scale ranges from most bearish at 0 to most bullish at 10. By year-end US Federal Reserve, European Central Bank and Bank of Japan asset purchases will turn negative year-on-year, strategists pointed out. High-yield outflows are accelerating, with redemptions for 8 straight weeks, while investment-grade inflows are losing momentum. One constant through the market turmoil has been the tech sector. Global tech funds did slip last week, losing $0.2 billion, but have drawn in record inflows of $42 billion so far this year, even though the market cap of U.S. tech stocks already dwarfs the combined market cap of emerging markets euro trademark and Eurozone equities. The prospect of rising rates has also revived interest in financials, whose profit margins are set to gain, and global financials drew $1 billion of inflows this week. Active management continued its comeback. Actively managed funds saw their biggest inflows year-to-date since 2013.